Hey guys, welcome back to another video. So we've all heard about short selling, we've heard about short squeezes with the GameStop saga, and we've also seen Michael Berry with The Big Short and various other things proclaiming how good short selling is. But what exactly is it? How does it work? Well, we've all heard of a long position, right? When you go long a stock or equity, we believe the price is going to go higher. So the game plan is to buy low, sell high. Well, short selling is when you believe the stock price is going to go lower. So you want to play the opposite. You want to not buy low, sell high. You want to sell high, then buy back low. Okay, but the problem is you don't have the stock to sell. So what you do is you go and you borrow it. You borrow the stock you want to sell and you sell it. And then you hope that the price goes down, which is what your conviction is. And then you're going to buy back at a lower cost and give it back to the person you sold it at. Sounds simple, right? That is short selling in an essence. Now, there are a few more complications in this because your broker, whoever gives it to you, who sells you the share, will command an interest rate. So for the time you're holding it, you'll need to pay an interest rate. But the aim of the game is you want to be able to buy a stock and then you want the price to go down. So you're betting on it to go down. And then you want to buy back lower and give it back to the person who you just borrowed it from, and you'll pocket the difference apart from the interest. Okay, but why is this? Why is there so much confusion around short selling? Well, the reasons are there are a lot of risks when it comes to short selling, and we're going to cover these shortly. But fundamentally, and the reason why I don't short sell is because it's ethically wrong as far as I'm concerned. I don't feel it's right to bet on a company to go down. I feel like there's plenty of other opportunities for you to get capital growth, in fact, far more efficiently with less risk, as we're going to cover shortly, going the long route. It's never been my style to kind of, hit a company while it's down. Even if I believe a company is struggling for the next 6 months to a year, I don't want to short that. I'd rather put my money in a company which I believe is going to do well. And I think it comes down to the saying of, I want to build a skyscraper by building a tall skyscraper, not by knocking everybody else's down. And I think that's probably the best way to think about business and stocks and investing. We don't want to knock people while they're down. We want to trade ethically and sustainably. But even if that didn't resonate with you and that's not important to you, let's look at some of the risks, because we have to remember first there's a buy-in risk. When you borrow that stock, it's not yours. Okay, so one, you need to post margin, which is collateral, and you can get a margin call on that. So if the stock price moves in the wrong direction, you will get a phone call to say top up your account by this amount, because you need to prove to the broker that you can afford to buy that stock back whenever they want it. And that's the thing with buying risk. The broker can ask for that stock back whenever they want. If they find out that their client's portfolio needs that stock, or they just want that stock back, they've got the legal right to ask for you to give that stock back, regardless of the price it's at. So your conviction could be right that the stock price is going to go down, and it could be on its way down, but they can ask for it back and you can be out of pocket. Okay, and a lot of people have got caught out doing that. And then the next, and probably the reason you clicked on this video, is the short squeeze. And to understand this, we need to understand that there's a skewed risk profile in short selling. So let's say you buy $100 worth of Tesla stock. Now, if you're long Tesla stock, the maximum, and the stock price goes down, the maximum you can lose if Tesla went to zero, which is very unlikely, is you'll lose that $100. So you have a finite risk element. It's $100 you're going to lose. If, however, Tesla was to go to $1 million per share, all that upside theoretically is yours. You have infinite upside. Okay, so you can keep profiting as long as Tesla continues to go up. There's no cap to that. There's no ceiling. Now the opposite is true of a short sell. You have a finite element to your upside, but if the stock price goes up when you're betting on it to go down, you could be called out massively, and that's where we come to a short squeeze. So let's remind ourselves, what is a short squeeze? We believe the stock price is going to go down, so we go borrow the stock. So let's say we go borrow a stock for $100. We believe it's going to go to 10, okay? But now the stock goes to $200, right? So we've already sold at 100. We need to go buy back at 200, so we've lost $100. Now imagine it goes to 300, 400, 500, and it keeps climbing. This is what we saw with the GME AMC, and it's called a short squeeze. And what happens is as short-term traders buy a stock, they can drive the share price up. Now you are in a long-term short position. So you think long-term the stock price is going to go down for whatever your reasons, but the short-term traders are pushing this share higher and higher and higher. And you become more and more forced to close out your short position because the share price is just going up. And if those traders hold their position and don't sell for any lower price, eventually you're going to hit your expiration and you'll need to sell your short position. Otherwise, interest fees are just going to get exorbitant. Because remember, you've borrowed it and you're paying a daily interest fee. Okay, so the risk profile is really skewed and it can make it really uneconomical for you to short a company. And that's one of the reasons I will never short. I always long. I don't believe short selling is the best way to build wealth, nor is it the most ethical. But even from this perspective, if you were to understand what is the risk profile, you have infinite risk if the stock price moves against you. So you're betting for it to go down, the stock price climbs up, you're exposed to each of those elements. And that's what we're seeing with GME. That's what we're seeing with AMC. We saw that with support.com recently the other day. These are short squeezes and it's capitalizing on these hedge funds who are trying to suppress these companies and short sell on these down-ridden companies, right? And the retail investors are fighting back. They're trying to protect these companies. They're almost kind of fighting back against the establishment and creating these short squeezes. Now, in order to identify which companies are heavily shorted, you can look at something called the short interest percentage to float. So of your float, which is all the stocks available, what percentage of those are held in short position? And when you look at that, that's where you had GameStop come up on the radars. More were shorted than available on the stock market. Now, how is that theoretically possible, right? But that's how badly shorted the companies were. And some of these, you're seeing are high double digits, 60%, 70%, 50% short. And that's how you can identify which companies are the most likely to short squeeze. And that's what retail investors have gotten together and figured out. They can find which companies are heavily shorted, which ones have a high short interest to floats with soon expirations where they can squeeze out all these short investors who are trying to keep the stock price suppressed, keep pushing it down, putting out negative articles, FUD, fear, uncertainty, doubt, to make investors wary of investing in the company. Whereas when these short-term traders buy the stock and hold and keep the price moving up, now the short sellers have to cover their positions, right? Because they need to buy the share back to give it back to the person they borrowed it from. But when they go to buy it back, the share price has gone up. So they they borrowed the share at 100, now it's at 150. Then it goes to 200. Now, if they're covering at 200, that means people are buying at 200, which pushes the price to 250. Now people have to buy at 250 to cover their positions, which pushes the price up to 300. And that keeps going. And as the shorts keep covering their positions, it just goes exponential. And that's how you get your phenomenal short squeeze. All right, guys. So there's a quick video on short selling and how it works. And we touched a bit on short squeezing as well. If you want a more detailed video, please comment below and I can spend some more time explaining short selling and some of the more technicalities. But hopefully that gives you a good introduction. We'll see you in the next one.